for the third time this morning, it needed updates. So here we are. Well, welcome to the September meeting of the Somerset Council Pension Fund. Welcome everybody this morning, including our individual and Mr. Remus, a guest in the room. And I see we have a number of people online. Rachel Lamb, who we're expecting a report, and Sil. I hope I pronounced your name correctly. If I haven't, I do apologize. Okay, so we're going to move on to the agenda proper. Item number 1 is apologies for absence. I'm not aware of any. David?
Apology from John Cookwood.
Okay, thank you. And Mike Hewitt. Are there any declarations of interest? Members of the I mentioned this. Don't know whether member of the okay, thank you. And moving on to item 3. My apologies,
Chairman.
Right, the minutes of the previous meeting on the 13th of June. Is it your wish that I sign those as a proposed? Seconded, Michael? Those in favour? Excellent. Thank you, I will do that. Okay, we're going to move on to public question time. Turn to Anton and Mr. Remus now. Remus, good morning. Welcome.
There are times when committees need to maintain secrecy around some of their investment decisions because of business sensitivity. I appreciate the deliberations around which pension pools Somerset is considering joining of some degree of sensitivity. However, decisions about pension pools have a large public in. I would feel concerned if this aspect is not to be shared adequately. Do include current and deferred pensioners as well as Somerset Council taxpayers. In our recent evidence to the Parliamentary Committee on the New Pension Scheme Bill, Southwest Action on Pensions expressed concern about the possible threat to local democracy that is involved in the reduction in the number of pensions pools. A distance. The sheer size of these pools and their distance from the pensioners that they serve now risk limiting our access to the pensions providers on rely. Hitherto, I have found that access to my own PFC has been very good, and it has even been possible for Southwest Action on Pensions to engage with Brunel Pension directly. Such access could now be in jeopardy. We understand the Wiltshire Council and most recently Oxfordshire PFCs have recently decided to join the Central Pension Pool, whose record on responsible investment in relation to climate change is reasonably good, though probably not as good as that of Brunel Pension Partnership, still in need of improvement. We are therefore concerned if Somerset Pension Fund Committee were to join a pool that is less committed to maintaining its standards on responsible investment, especially when it comes to climate change. I note that at the PFC meeting on the 12th of September, item 13, which is about pooling, may be taking place with the public being excluded. Given that there is so much at stake in these deliberations, I ask that the committee provide more details about why such an exclusion might be being considered necessary. Thank you.
I've prepared a response as usual before the committee, and I will email it to you as soon as I finish reading it. Discussions regarding which pool the Somerset Fund intends to join will involve details regarding the prospective pools, their capabilities, their fund manager partnerships, and financial details that are not in the public domain. These details are commercially sensitive. To discuss them in open committee could compromise these entities and the Council's ability to have a trusting relationship with our chosen pool going forward. The success of the pool we join will be critical to the financial performance of Somerset Council Pension Fund. The decision of Somerset Council that this meets the threshold required for it to be held in private session is consistent with how other Brunel funds have dealt with this matter, including Wiltshire. It is anticipated that the decision of the committee as to which pool it wishes the Somerset Council Pension Fund to join will be made public at an appropriate time before the government's deadline of 30th of September 2025. We note your concerns regarding the financial and ESG performance of prospective pools, but we remind you that the closing of Brunel was mandated by government against our wishes. We will work with our new pool and all of the partner funds attached to that pool to provide the best outcomes in all areas, including these, going forward.
Thank you very much for that, Anton. We're going to move on now to item 5, which is the Independent Investment Advisors Report, which is to receive a verbal update. So, to Caroline Merrick. Good morning, Caroline.
Good morning,
Welcome, as
everyone.
ever. Good morning to you.
I was going to expand somewhat on what I'd written because a certain amount of information has come out over the past few days, which changes the picture a little bit. It's dangerous to get too excited about 1 month's data, but I think this is probably quite important in that an amount of data that's come out over the past few days has suggested that the US job market is a lot weaker than was expected it to be. This, I think, makes a cut in interest rates sooner rather than later more likely. And the other thing that's happened is that the inflation data has also come out in the right direction. This is a bit surprising because we don't seem to be getting the feed through from tariffs that we would have expected. There are 2 possible explanations for this. One is that companies are allowing their profit margins to be squeezed. The other is that much more stock was brought into the US before the tariffs were put on than was perhaps recognised. Either way, I think that we will see an interest rate cut. Doubtless President Trump will say it isn't enough. The other thing I think this doesn't mean is that we are going to get renewed concern about economic weakness. Economic weakness had been expected before, and I think everybody's been quite surprised over the summer just how robust most economies and markets have remained. But I think this will start to creep in. And the other thing I'd point out is that for some reason that nobody can explain, throughout most of my professional life, markets have weak Octobers. Some very significant, some not so significant, but there does seem to be a pattern here. And of course, at the moment, you've got an awful lot of technical situations where holdings are held by hedge funds with a lot of gearing, which then has to be unwound quickly. So we could be in for a volatile October, but I would be inclined, until there's more evidence to say otherwise, to say this is just something you have to ride through as we've ridden through all previous Octobers. But I'm sure there will be headlines saying end of the world just around the corner. Just as we saw all these headlines about how the UK was going to have to go to the IMF, until we had an extraordinarily successful gilt auction last week. And since then, the people who were putting this line forward have basically either gone back into the cupboard or decided to turn on France and say it's France who's going to have to go to the IMF, for which there might be a better case, but not a very strong one. So that would be where I'd update on what I previously said. As always, I'm very happy to expand on anything I've said or answer questions on anything else in this area that people would like to throw at me.
Okay, colleagues, questions for Caroline?
Thanks, Caroline. Just one question. Your comment about the interest rates and the lack of inflation impact from tariffs. Interest rates are obviously looking at the underlying market, but you mentioned that holding stocks might have been a reason why that didn't have an impact. Obviously, that's a short-term, finite action, isn't it? So why would that have an impact?
Well, because companies had bought in stock at lower prices, they're able to put it out into the market without raising prices, without hitting their profit margins. And it's, certainly was clear from the Chinese export data that before the tariffs were brought in, an awful lot of goods were shipped to the States, well ahead of what you would normally expect to see. It may be that there was even more. But yes, if this is what's happened, it's transitory. And new stock will have to come in and pay the tariffs. But it is possible, I think, that what we might have had particularly is a lot of pre-Christmas ordering coming very early.
Is red, is that right? Hello, Caroline, thank you for your update. I just making a general observation and sort of question really. A lot of governments are in significant amounts of debt, I think it's fair to say, and you're highlighting the French as being the one that's just above the parapet on that line. But in terms of generally the outlook for governments, there's still borrowing is still quite high, the rates for borrowing, gilts, and the future can only go one way on that basis, I would have thought. Well, those debts aren't going to vanish mysteriously overnight. So what is the future looking like if that continues to rise? If debts for governments continue to rise, at some stage, people might decide that a lot of governments are unsafe to lend to. But I don't know. I'm not at all aware of how that pans out.
I think the problem is for many governments now, the UK being one, that a very large amount of their taxation is now being used to pay the interest on outstanding debt. And it is, there is a question of how long this can be sustained. On the other hand, again, I've spent many, many years in the market being told that the US cannot afford to pay its debts, and somehow things always muddle through. What you've got to assume is that the people who hold debt which is about to mature will not roll it over. And on the because there are lots of people who, for various reasons, want to hold government debt to match liabilities for security and so on, the rollovers have happened. The question is what price they happen at. Now, if you want to say, right, people are not going to buy government debt anymore, you have to say what they're going to do instead. Now, I think what you've seen over the last 15, 20 years is quite a migration from government debt to corporate debt. But obviously that is less secure. It requires greater analysis to follow. So am I complacent about it? No, I'd obviously like to see governments around the world recognise that they cannot afford the welfare systems that they run. But the problem is that politicians are not very good at saying no to the electorate in terms of, no, you cannot have these benefits anymore. We can't afford them.
Thank you.
I'll just interject there that our exposure to government debt beyond the UK is de minimis, typically. I mean, that doesn't necessarily protect us from the economic consequences of problems in a given government debt market, especially if it's a major European country or the US. But it's not a big part of our exposures.
But things do fluctuate a lot. I mean, a few years ago, it was Greece that was in the most terrible state. Greece now borrows at a lower rate than France because they did actually, forced to by the European Central Bank, they did actually put some pretty tough measures in place and cut back. But we have a situation where I think the other thing you've got to think about is demographics. In the West, we've got an aging population. So there are fewer and fewer working people who generate the tax revenue, supporting the children and the old. And that again is a real issue, I think. I mean, the triple lock, I think, is an absurdity personally. I may benefit from it.
And as a natural follow on from that is the immigration of working age people coming into all the European countries to provide that working tax base that provides the payments for the welfare payments. So
So over time, of course, those people themselves
will
become
become
elderly
elderly
and become dependent as
and
well.
become claimants. Yeah.
So you've got to go on doing it.
Councillor Farmer.
Thank you, Caroline. And thank you for mentioning the end of the world. I think we've got a public house not too far away from here that you can actually go and enjoy, drink and a meal. But in terms of severe spending cuts, that if countries like France is going to be impacted, surely that will have a rippling effect on the rest of Europe, because we are not immune to it. How do we actually hedge against such things? Are we likely to?
I don't think there is really a hedging mechanism that would do very much for you. I do think France is a particularly unusual case in that, on the whole, elsewhere in Europe, the younger population recognises that things will have to change even if they don't necessarily like it. Whereas young French people believe that the state can solve everything. And they also have this great belief that if only all the rich people were made to pay lots of money, it would all be sorted. But unfortunately, there aren't enough of these mythical rich people to, even supposing you confiscated all the assets of the top 1% of the population, it really wouldn't make much difference.
No, I'm fine, thank you. It's a topic we could continue, but I think it's just relative to their funds, it probably is, we are unable.
Don't think there's much doubt there's going to be some more movements. David.
Thank you. So one of the big drivers of the world economy has got to be the price of oil. And with Russia seeing so much capacity taken out, I think that's now been soaked up by the Arab states, and they've increased their capacity and started actually reduced the price. I just wonder if the market's factoring in that support mechanism may start to disappear if there's more conflict in that area, and therefore actually that would push up prices and make things much more difficult.
I think the general forecast in the oil markets is that things are going to stay pretty flat price-wise. OPEC would undoubtedly like to get a slightly higher price. Saudi needs it for its own economy, but I think it's recognised that the last thing they need to do at the moment is try and push oil ahead and generate a recession of any kind. The Russians are selling their oil to the Chinese and the Indians. It's all going out all right, but of course they're not getting very good prices for it.
And then the Indians are selling it back to Europe. So.
Quite possibly, yes. Yep.
Sorry, I'd like to continue my thanks to you, Caroline, for another excellent report, and thank you again. And you are, of course, more than welcome to remain with us should you so desire. Okay, we're going to move on to item 6 then, which is the review of the investment performance. That's to consider the report from the Treasury and Pensions Manager.
Thank you, Chair. As usual, I am going to limit my introductory remarks to the combined fund, starting on page 32 of the public pack. But I'm happy to take questions on any of the individual areas of the fund, should the committee members wish to. As we've sort of touched on with Caroline, it's been a remarkably benign period of markets, although there has been considerable volatility, especially in the quarter between the 1st of April to 30th of June. So Trump announced Liberation Day, where he got out his clapperboard of tariffs. I think that was the first week or 10 days of April, and the markets did react quite negatively to start with. I think then everyone realised slowly that Trump has a negotiating tactic, and so there was an opening salvo. I think the end point is probably not as bad as most people feared, but probably slightly worse than they had hoped. And markets have swallowed it for the moment, but Caroline's comments about the weakening of the US economy, obviously, if that flows through to economic data, if the tariffs flow through to a weaker US economy, then that at some point, markets will not like that. And whether that means that we get a pause in markets or a retrenchment remains to be seen. So quarter in question, a 4% return for the fund, and broadly speaking, with one noticeable exception, Brunel's funds outperformed the benchmark, their respective benchmarks, and in some areas by significant margins, which was good to see. And generally speaking, now that the quarters to March and June 22, which were particularly affected by the initial Russian invasion of Ukraine and the market reaction to that, have dropped out of the 3-year numbers. With one very notable exception, most of the portfolios on a 3-year basis look okay now. The one notable exception is the Global High Alpha account, which is a bit of an issue for us because it's by far our largest exposure. Brunel are aware of the issues with that. I do expect to see some changes in that pre the sort of reorganization of our pooling arrangements. But obviously with Brunel now, there are lots of conversations around projects that have either been started or might be started as to whether they represent good value in a world in which Brunel in its current form will not exist. And so, and we're more or less now at a basis of, is this essential? And if the answer is no, we probably won't do it. But I do still expect a change on that account for reasons that are not in the public domain, so I cannot share with you at this time. And I think that, let me just, yeah, that was all I had to say at this moment, but I'm happy to take questions.
Questions for Anton? Michael?
I'm just wondering what, I mean, we got a fairly insignificant 62 million with Nyberg. Is it Nyberger?
I believe it's usually pronounced Neuberger, but that is a point of open debate in the market.
Yeah. So they got, I mean, 5% is a considerable reduction in value, but we don't have much, you know, comparatively invested in them. What are they actually? What's in them?
So those are private equity funds. The way a typical private equity fund works is you make a commitment to a fund, and that, say, I think in the instance of the first fund, I think it was something like 20 million, if I remember rightly. That commitment will then be drawn down over a period, invested, then slowly the investments will mature. They will take receipts from that and give them back to us. And that process is always anticipated to take at least 10 years. And usually, especially these days, seems to take nearer 12 or 13. And I say that with the where you should bear in mind that the original portfolio we invested in with Neuberger is called the Crossroads 2010 Fund, which may give you a hint as to when it started. And two things are happening with that particular private equity. So usually what happens is you get a new fund every 2 or 3 years that you commit to, and you build up a suite of 5 or 6 of those that are in various parts of their life cycle. As we switched from doing that with Neuberger, where we got to 4 funds, to doing it with Brunel, where we now also have 4 funds, no, 3, correct, my mistake, sorry, 3. That means that for that Neuberger pot, there is no longer a balance between new investments in their growth phase and older investments that just need to be liquidated and returned to us. So that is starting to become an old portfolio, and therefore doesn't develop in quite the same way. Also, that portfolio is exclusively priced in dollars. So the fact that there was some dollar weakness during the quarter without compensating returns in that particular portfolio means that from time to time we will get significant losses appear on a quarterly basis. I think the thing I would sort of highlight with that is, I mean, we always report quarterly, and it's right that that information is in the public domain, and we need to be aware of the present, but especially with private equity, the long-term returns are what matters, because you've made a commitment to something that's going to take 10 to 12 years to fully work through its process. And on page 30 under spot 13, that is the Neuberger Berman section, and you can see that over 10 years, their portfolio has outperformed listed markets, so effectively what would be our genuine alternative, by 1.5% per year. So in the long term, that investment has provided an adequate return, and I am not that unhappy, but also because it's in its what is typically referred to as its harvesting phase. Now, there's not a lot we could do. It's just a question of waiting for the money to come back and the various legal structures to be collapsed. I believe the 2010 fund will be wound up at least by the end of calendar 26.
It's a good example, actually, isn't it, of having to have a long-term investment plan.
Yes, and the illiquidity because it's a 10-year commitment. They are illiquid. It's very difficult for us to get to just liquidate that. It is possible, but it would typically be at a significant discount. That's why the amount of we invest in it is relatively modest.
Thanks.
And it's also, as I sort of hinted at, Neuberger are not alone in their private equity vehicles taking longer to mature or to close down, particularly as one of the routes that they use to move on assets, liquidate assets within the funds is IPO. initial public offering on a public market. So it'll be a private company that's not currently listed on stock exchange, and they will list it on a stock exchange as the way of harvesting the return from that particular investment. Probably, I'm looking at Carolina, probably since Russia invaded, or possibly going back to the start of COVID, it's been the ability of private equity to list new ventures has been patchy at best.
I would say it's been closed. I mean, I would say at the moment, the only way that these investments are being realised is through trade sales, which doesn't make them bad investments, but it does make it a longer process, a more difficult process. And I think trade buyers are probably somewhat more canny about what they're prepared to pay for them than when things go to IPO.
Just picking up on that, this sounds like a set of characteristics right now that would really put us off being heavily exposed to private equity as an only option, precisely what the government intended us to do in the reorganisation of pension funds.
Yes, I mean, one of the things that's a slight movable feast is the pensions bill as originally drafted is working its way through Parliament, and there were some amendments accepted by government, I believe. This isn't something I'm following uber closely because just life's too short and there's lots going on at the moment. But my understanding from email traffic that I see, not having looked at it myself, is there has been some amendments to the government's bill, and the government's desire to mandate UK investment and private equity investment across the pensions landscape, I believe, has been removed from the pensions bill. That may not mean that it gets removed from the LGPS as legislation works its way through, because obviously LGPS legislation around investment strategy statements, etc., is secondary legislation. Pensions bill is primary legislation, will come in due course, and that will give the government the option to put back stuff for the LGPS. But it looks like a situation where government was going to mandate this across the pensions universe has gone, and so if that is replicated in the LGPS, we may be in a situation where we are encouraged by government, but it remains our decision. That's one that I can't give a full answer to at the moment, because, as I say, until the pensions bill is signed, or given royal assent, and then obviously we see secondary legislation and government guidance over the next year or so, I can't be sure of where we'll end up.
Chairman, I think the question is who's looked at what, because the push for private equity seems to be, you get a higher rate of return for private equity. Well, yes, historically you have done, but the main reason why you do is because it's got more debt in it. It's higher risk, so it ought to give you higher return. And I'm afraid I think we've had a situation where civil servants have just looked at numbers and don't understand risk-adjusted return. And it may be that some words are being dripped in their ears to say it's not as easy as you think it is.
I think there's also a case there that private equity is still, in institutional pension fund space, a relatively new investment, sort of having started in the sort of mid-90s, a bit earlier. But yeah, my point is, though, is that the returns achieved in the funds that started in the 90s and 2000s, which is what's on public record to some extent, when it was a more niche investment, I would suspect may have been better than those going forward, because now it's a more mainstream investment. There's a lot more money in it. It's harder for all managers to get the same returns because there's more managers chasing each investment, which means drives the price up a little bit. And so you know, the overall pot just gets squeezed down a bit. That's not to say you won't get reasonable and fair risk-adjusted returns from it going forward. But if you look back and you say, oh, these guys outperformed public markets by 10-15% at a period of time, I don't think you're going to consistently see that going forward. And again, Caroline might agree or disagree.
No, I think that's right. I mean, when I started doing this, the benchmark that we used to work with was that they needed to give you 5% over FTSE to be justified. And I think Anton is right. In the early stages, that wasn't so hard to do because it wasn't so hard to find interesting investments. And also, you probably didn't need to run quite as much gearing into them as you've had to now. The other thing, of course, that goes on in private equity now, some of which I think is good and some of which is bad, you have a lot of assets being swapped between different private equity funds. And whether the prices there are always sensible is another question. I mean, sometimes it makes perfect sense. I mean, I can give you an example of one I know which is a Spanish charcuterie business. The family, the old story, third generation didn't want to take on the business. It was bought by a private equity firm in the Iberian Peninsula who geared it up and spread it out and got it selling in Spain and France. But they got to the point where they couldn't take it any further. So they sold it on to a more global fund who were then able to develop it so that it became an international brand. So that kind of selling between private equity funds is absolutely fine and absolutely makes sense. But you do get some which is just rearranging the deck chairs on the Titanic, I think.
I've got a feeling that Boots has worked its way through 2 or 3
Sure.
private equity managers, and then when it's gone public again, hasn't it?
Public.
Yeah. So and that is the less convincing part of the market.
So the larger point that I was trying to make here, and thank you. I think it's been really useful to have that discussion. When we were considering the consultation papers around local government pension funds, I think we were all aware of the risk reward issue, and that this was not necessarily an area where we wanted to be directed. We wanted freedom of movement. What has emerged in this discussion today is that there are some unique features currently in play around the harvesting phase, which make it an unattractive, illiquid situation, which just following the logic, as that's a global cause, and I think it was the gas shut off that started it rather than COVID, but it was certainly around that time. Whilst it was global cause, that applies to absolutely every fund around the world, which means that when the pressure is released, the market becomes flooded with a backlog of people who are trying to actually reap the benefits of their investment. So that will lower the market clearing price. And that's not places where pension funds want to be. They don't want to be where external factors are what drives it, and the external factors apply globally, because there's no advantage to one firm versus another to be had. Everybody's in the same boat. And unless there were a longer period of history which said that, now that it is a mainstream investment, it's still returning substantially more, why would you ever go near it with a pension fund as mandation? You might go there from choice on an assessed basis, but you wouldn't go there because you were being regulated to. Yeah. And the key thing is, this regulation is upon us. The Act is making its way through Parliament. We really should be making sure that the parliamentarians, or either the sector is still lobbying and hasn't stopped peddling the lobbying bicycle, or local parliamentarians are being briefed with what we know about the issue of the harvesting phase, because we really want it out of the bill. We don't want it in the sector. By all means, give us the freedom to do it, but don't give us the duty to do it. That's the simple truth. And I just think time is upon us. That's why I was pushing the point.
The other thing to remember about the harvesting phase is that at the end of your fund, you will inevitably have the things that nobody wants to buy off you. There's always a tail which takes years and years to get rid of. That's part of the structure. Everybody knows that's going to happen. I mean, if you look at what happens with a typical private equity fund, you'll get two real winners, you'll get two that go bust, and the things in the end will kind of muddle through. It's exactly like drilling for oil, actually. You get it's a particular shape of the portfolio. It's not even at all in the way the returns arise. So I think it's absolutely right to say you don't want to be forced into doing it, particularly if you put in a UK bias, because frankly, I don't think the opportunities are there.
And Neuberger will, on their funds, because obviously the 2010 fund, although the first we're invested in is not the first of that series, they will reach a point where they go, we feel we've reaped sufficiently from this, we will sell the rump at whatever price almost to allow the structure to collapse and you know, just close it off and move on. The other thing I'll just say is, I think the reason that the government has adjusted their position on this is because they got lobbied hard by the city and the professional pensions groups, and not because the LGPS said anything, because they don't listen to the LGPS, but they do listen to the wider economic market.
Sorry to press the point, Chair, but the government believes they own local government. They believe they can do what they want to do politically by demanding it of people they control. This is the point, that's a local government pension scheme is not a government instrument, and they ought to be kept well clear by Parliament.
I think your point is well made, and I think there is an avenue by which we should remind government via our parliamentarians that is the case, because we do not want to be mandated to doing any particular, because it's very easy then they just say buy all government gilts.
There's a group of people in the Cabinet Office who are the real poison. So if any of you have any contacts in the Cabinet Office, that's who you need to lobby. Civil servants there.
Sorry, Chair. So you just said that there's a mechanism to lobby. So what are we going to do?
Well, I'm just coming on to that, David,
Good.
but thank you. Thank you for asking. I think my suggestion would be that Anton and I write to our parliamentarians, our local parliamentarians, indicating where we are as the LGPS in this, because of our responsibility to our pensioners, and that we feel that they should be aware of this situation. Now, I'm happy to listen to alternative suggestions if anybody hasn't. Peter, you may have one.
Not alternative, Chair. I'm wondering if the LGA has a financial lead, a sort of local government finance lead, who might also lobby on behalf of the sector.
You should speak to the LGPS Scheme Advisory Board.
Yeah.
Slightly outside of the LGA's remit, I think, because it's separate. So I've certainly not come across it.
Yeah, the LGA effectively now provides the secretariat to the LGPS Scheme Advisory Board, and that would be the premier way for the sector to lobby government.
Are we suggesting, Anton, therefore, that we, as a pensions committee, write to the LGPS Advisory Board?
I would suggest that I check who's on the investment subgroup of that, because it may well involve an equivalent of mine that I am acquainted with. I suspect that the message is already gone, but I will need to follow that up as to, because I am aware that I'm fairly sure they have a investments subgroup that meets periodically.
Okay, I'm going to take you
Okay, in my head at the time that this was forming, I was thinking this is actually a matter of parliamentary debate, really, because it is the introduction of the idea that you have this harvesting phase at the end, and that, in your words, that's been closed. You know, that is a simple rhetorical point that then puts the minister having a word with his advisors and asking awkward questions of them, and that's how you control the Cabinet Office enthusiasm for historic performance.
I think the most influence that we can have is directly with our parliamentarians as opposed to the LG, whatever it was, the advisory board, purely because I think the advisory board are probably onto this. Whereas for the MPs, it's probably way down their agenda at the moment, but needs to come up the agenda. The only thing I'd say is if we do write to them, we should then advise the advisory board that we're doing it and encourage other authorities to do exactly the same.
So are we content that Anton and possibly myself as the chair write to our parliamentarians and to the LGPS advisory board as appropriate with our views on this subject? Yes? Is that Anton?
Yes.
An action for us to take away?
Yes, I suggest I would draft something, but it would be in your name.
That's
But obviously, once you've
I will read it before I sign it.
Yes.
I promise you. And if I don't understand it, I'll make sure I do before I sign it. But yes, I think we should do that. Okay, so that's actually a clear action to take away. Thank you, committee, for that. I think that's useful. Okay, do we have any other questions for Anton at this stage? No, with that note, that report is to be noted as well. So we're going to move on now to the review of the pension, review of administration performance, and we consider the report from the head of Peninsula Pensions. Good morning, Rachel, and
Good morning.
Very, very welcome.
Thank you, Chair. Good morning, everybody. So I'm just going to give you an overview of the usual report, the administration report, to start with. So this report relates to Q1 of the financial year. So it's relating to the performance of Peninsula Pensions, the administration team, between April 25 and the 30th of June 25. So for the first quarter, as usual, we break down the performance into different priority areas, which you will see on page 43 of the pack. The high priority area covers the retirements and survivor pension benefits. So the areas that you would expect to be high priority, where there are payments due to scheme members. And the performance for Q1 was 95% were in target when measured against the occupational and personal pension schemes regulations, which is what we are, the performance is monitored against. And 95% covered the high priority areas as well. So it was the same across the whole area on average compared with the high priority areas. So like I said, there's a further breakdown on page 43 of the different areas, high priority, medium and low priority areas, which we try to balance across the team. During the quarter, we had 8 recorded compliments from individual scheme members. We also have a couple of areas. There's Appendix 2, which highlights the sort of longer term performance of Peninsula Pensions. Basically, we have outstanding on page 46, you'll see that the amount of work that we have outstanding, there's 1,865 pieces of work, if you like, across all the different areas for scheme members that's pending. As at the end of June, to compare that with last year, as at the end of June, where we had 2,701 pieces of work outstanding. So there's been a significant reduction in the last 12 months, despite numbers increasing. So in Appendix 3, we keep a rolling chart of how much we're receiving in, calculations we're receiving in, retirements, transfers, etc., across the whole team. And the workload has increased, yet we've still managed to bring the outstanding level down, which we're very proud of. There's also a couple of areas that are mentioned in the report, which I can actually give you a bit more of an update on since writing the report. I will also include it in the next quarter in writing, so you'll have that sort of officially documented too. But we have on page 42, you'll see that there's some other projects that we've had underway, which is the age discrimination casework, referred to as McLeod Remedy. So you'll see there that there's a note to say that any members that were due additional pension money, so any pensioners due extra monies as a result of the remedy, we had to recalculate and notify the member of what the revised amounts were by the 31st of August. This I can just now confirm. Obviously, we've gone past that date now. That was achieved. It was a big job for the team, because it wasn't just the Devon Fund, but it was also sorry, not the Somerset Fund, but the Devon Fund as well. So we had 2 LGPS funds that we needed to do these recalculations for by the 31st of August. For the Somerset Fund, we've achieved that. There's one case that was outstanding, which we're just waiting for information from an employer on. So just to update you on that. And 5.2 on that same page, 42, mentions the National Pension Dashboard. And I'm pleased to say, hot off the press yesterday, we have connected live with the main scheme benefits, including obviously the Somerset LGPS fund. That doesn't mean that individual members can view the information yet. The connection date was the 31st of October 25, so we had to be connected by then for the deadline. But it now means that data can be tested, which is now available. And like I say, that's live and connected. So I say main scheme benefits because we still need to connect AVC funds. So any AVCs, additional voluntary contributions that members have paid that are in-house linked with LGPS, are not yet connected. So we're working with those parties as well to get that aspect connected. We've got on, well, I'm going on to my next report. I'll pause there because the next report is the employer report. So I'll pause there. I'm happy to take any questions around the administration report. You might note that some of the employer information that's normally in the report has actually been separated out into a second report, which I'll speak about shortly.
Okay, members, do we have any questions for Rachel?
Overall, really happy with the admin performance, and you've held that improvement from a slightly lower point of a couple of years ago, so that's really pleasing. Could I just clarify the McLeod point? Are you saying that you have now completed all the recalcs for all of your McLeod? No, sorry, I'm not saying that. No, what we prioritised for the 31st of August were just those that were due extra monies. So we still need, before next year's annual benefit statements go out. So we're aiming for the 31st of March in advance of that to do are those that aren't due monies now. So those that have got deferred benefits, those that have had transfers in that need recalculating, any aspect where we've got records or members that have got pension benefits that are not in payment that are impacted by the McLeod remedy still need to be actioned. So we've got a plan between now and end of March for those other calculations to happen. The priority was to get monies out to those that were due monies as a result of the remedy. Thank you. That makes much more sense, and it's still a big achievement. Could I just ask for one thing? In paragraph 5.1, the McLeod paragraph, I think you do this each quarter. You say there are a certain number of individual scheme members identified as requiring a review.
Yes.
Could we just have something that shows how that number changes?
Absolutely. Yes. So this was as at this point, as at June, the 2971. What we'll do is in the next quarter, because we're sort of a bit behind on the quarters, in the next quarter, in the next report, it will include those pensioners that have been actioned, and it'll also include any other recalculations we've done. So it will show the lower level. So yes, absolutely, that's the intention.
Excellent, thank you. David?
Thanks very much. A couple of comments. First one was, I'm sure the HMRC would not want to see themselves as not a high priority, but they are medium, I see. So I've always viewed them as a high priority. But my question relates to interfund transfers and pension transfers. So understanding of interfund is that they are pensions that are already with you that are transferring to a different fund under your control. Is that right?
Yeah, so the interfunds in are if they're with another fund due to come into us, and out, so if it's going from ourselves to another LGPS fund. Yes, that's correct.
So you're controlling all the information on both of those funds. So I'm just interested why the performance is so much lower for interfund transfers than from outside, where you don't control the information.
So the interfunds coming in, the 67%, that's information that is coming from other funds to us, and then we need to update our records accordingly. It's the outs where we've got the data already and we send it to others that are the 88%.
So it's other LGPS funds. So an interfund in would typically might come from Dorset or Cornwall or Wiltshire.
But not necessarily controlled by Peninsula. Or...
No, I mean, there will be a level of interfunds between the Devon and Somerset funds, given our close proximity and that, you know, county halls in Exeter and Taunton aren't miles apart. There is, you know, there's always been individuals that move between the two, but as I say, interfunds will often involve Dorset, Wiltshire, Cornwall, and other wider LGPS funds, and therefore, at the end of the day, the money comes in, tick, but the details that then allow Rachel to update her records and then Rachel to pass that to us so we can update the accounting records can take longer.
And that was just my question, really. I'm trying to understand why they were slower than transfers in from an outside provider.
Don't know if I've got a really straightforward answer to say that. I think with the transfers in and the transfers out, because it's external companies, we try to prioritize those, whereas with the interfunds in and interfunds out, we have the data, we have a national dashboard, so we know what it is. We just need to get the information through and update on our system. There's been a delay with interfunds in and out linked with McLeod because a lot of them need recalculating before we can get the information in from other funds, and the same going out. We need to recalculate. So in that batch that referred to, the 2,971, I think it was, that batch, there are lots of interfunds where we need to recalculate and send information out, and like I say, other funds in. So there's a delay because of that as well, with those, which isn't the same with transfers in and out.
I also will just point out the high, medium and low priority areas are defined in the regulations. So it's not us that said that HMRC is medium. That's a national framework.
I just wanted
to
say,
we are on the national framework. Let me just reassure you, David.
With HMRC as well, maybe I could make that clearer. It's not the tax changes, etc., from HMRC that impact on pensions. It's relating to annual HMRC calculations, so like annual allowance and lifetime allowance. So I could make that clearer that it is annual events. So they're done in time, but they're just not at priority all the time because the deadlines are annual as opposed to with tax changes they're done straight away. So I could make that clearer on the report.
I'm sure HMRC is delighted. Mr. Farbahai, Habib.
Thank you, Mr. Chairman. Rachel, it's really good to see that the total performance against the occupational and pension scheme is actually at 95%. But given the increase in demand and ongoing McLeod and pension dashboard work, how confident are we that the current resourcing and investment strategies are resilient enough to protect the funds performance against future potential shocks such as the one we were talking about earlier on oil and other things?
Yeah, so we have a sort of a strategic management team within Peninsula Pensions, and we monitor all of this that's in the report and resources, how much is coming in, out for that reason. I have quarterly catch-ups with Anton as well, as part of our shared service arrangement. We have actually got an additional member of staff that was additional post, I should say, not the staff member yet, additional post to support with the pension dashboard work, which is going to be sort of on a contractual basis, a temporary contract for 18 to 24 months, purely because we're not entirely sure how much additional work this is going to cause the team until we're sort of live and rolling with it, if you like. There's a lot that's done. The connection is sort of automatic between between us and the dashboard, and then there's also, when there's some matches of information, the individual will contact us, and of course we've got our online service available, so the member will a lot of the time just go to the online service and be able to obtain the information they need. So it's a very difficult one to understand fully until it's up and running and in place. Longer term, how much resource is needed, but we have got a resource that's been working on the introduction and will be there to answer, deal with any queries that we get. We've also got 3 business apprentices that are joining the team the middle of this month, and the purpose of them is to have some apprentices that learn the whole team's work and to support some of this extra work as well, with obviously the intention at the end of their business apprenticeship that they will stay with the team as like a longer term plan for succession planning, if you like. So we are very on the ball with what is happening, how much is coming in, how much work we're managing to deal with. So I hope that gives you some assurance.
Okay, I'm not seeing any further questions for you, Rachel, on this, so we'll move then to, we've noted that report, and we'll move on now to item 8, which is the employer performance, which is the separate report that you mentioned, Rachel.
Okay, yeah, so we've separated this report out just to make it a little bit clearer when we're talking through for committees and boards. So this report includes some of the data, the performance of employers, and where we've had to request more information from them in line with our pension admin strategy. So you might remember that last year the pension admin strategy was updated, and we were having a real problem with not all employers, but a certain percentage of employers for getting data prioritised to come through for members in order that we could do calculations. So one of the additions to the pension admin strategy was obviously the engagement is what we want to do, engage with the employers and try and get the information through. But at the end of the day, if that wasn't working, there needed to be like an end result as to what would happen, a consequence of not doing that. And there were charges introduced in the pension admin strategy, which is allowable under the legislation. So what we've done is we've been trying to, over the past year, 18 months, we've been getting, now the admin strategy is there, we've been getting all of our outstanding employer queries sort of as up to date as we can. The last batch that we wrote out to employers about were any outstanding queries between April 24 and March 25. At the time there were 225 outstanding queries, so calculations that we couldn't do because we were waiting for information from individual employers. I am pleased to say that, again, this is an update that's not in the report, but it will be in the next report because it relates to the next quarter a bit more. The deadline for getting that information in was the 31st of August. The 225 is now down to 8 outstanding queries, which obviously we're going to need to pick up with the employers, and there will be potential there. The fines will be outstanding because there was clear warning along the line that that would happen if we didn't get the data by the 31st of August. But the good news is, obviously, the majority of them did engage with us, and we have got the 225 down considerably, just to just 8 now, just to a figure of 8. So the next tranche of inquiries that are being looked into will be anything that is outstanding from employers from April 25 to date, and they will be going out. The initial notification will be going out to those employers that are impacted this month, requesting that information to be in with, again, with a deadline of when that's due. So that is much better for the team. Obviously, that might mean that on the next quarter, the figures will go up a little bit, because whereas those 225 were sat as a sort of as a pending case, they are now with us to action. So it's a big batch for us to now action alongside everything else. So this report also includes, as you will see, there's an employer update. So on page 50, number 5, you'll see the general employer update, which I won't go through, but it just outlines new employers, admitted bodies and new academies, town councils, cessations where they're applicable. And then Appendix 1 on page 52 shows the number of leavers that we've had. So people that have left for varying reasons, between normal retirement, ill health, death in service, late retirement, or those that have opted out. You'll see there's a chart at the bottom which shows you those numbers and the reasons for leaving. So we had 892 leavers over that quarter between April and June. And on the next page, on page 53, it shows you the timings of employers, how long it's taken to get notifications through. So getting the data in for employers has been our priority. The next, as soon as sort of we're up to date, which we pretty much are now, because we've got 61 outstanding plus the 8. So we've got 69 in total outstanding across the whole fund of employer pieces of information that we need in. So now that we've managed to use the admin strategy to get those numbers down, our next priority will be to contact individual employers within Q2 and look at some of these timescales, how long things are taking and why they're taking, trying to understand why they're taking longer if they are. Appendix 3 shows you how many new members have actually joined the scheme over April, May and June over the same quarter. So you'll see that it's pretty much on a par. The starters that we've had over that period are 879, and the amount that left on the previous page that we looked at was 892. So there's not really a big discrepancy between how many are joining and how many are leaving. So that's just a bit of hopefully useful information to let you have. Priority reasons for leaving are notified at the bottom of Appendix 3, so you can see the breakdown of death in service, how many have been received sadly over that quarter, ill health cases, flexible retirements, and then the normal late retirements. And it shows you how long or how quickly information came through to us. So you'll see that with the ill health, the lowest time was minus 73 days. So obviously with ill health cases, there's normally a notice period. So in that type of case, we can get information through from employers in advance. Whereas with normal retirements, although in this case, the lowest time was minus 27 days, you'll see the highest time was 54 days. With a normal retirement, it's not always as quick, because sometimes it will depend on when the pay run is, in order that the final pensionable pay information can come through to us. So it's just to sort of give you an overview of timings across those different areas as well. I think that's probably it from me, so I'm happy to answer any questions on the employer report as well.
Colleagues. Not Michael.
I'm not sure if I've asked this before. I hope I haven't, but when people retire and haven't taken their pension, and then when their pension becomes due, How do you approach the subject of enhanced pensions where ill health becomes an issue? I mean, the actuaries work out that you won't live as long, therefore you should be paid a higher rate, which is rather macabre, but is the actuality of the situation. So how do you do that in-house, or do you sub that out to another company to take over?
So do you mean, just so I can be clear, do you mean somebody that retires on ill health grounds, or somebody that's had deferred benefits and then we bring them into payment at a later date?
Well, it could be anyone really, because when you retire, you don't know or before you retire, you don't know what your health is going to be like at the point of retirement. But let's say you develop a serious complaint, which might qualify you for an enhanced pension. How is that? How does that work through your system?
I see. Okay, so there are each employer. So it's depending on whether it's a retirement with somebody's actually working or someone's deferred benefits and they become ill. It involves a medical practitioner. So obviously we're not medically qualified to make the decision as to whether or not somebody should be entitled to early payment of ill health or early payment of deferred benefits on ill health grounds. So every case involves a medical practitioner report, and they guide each employer as to whether or not the individual should be entitled to that, and then the employer makes a decision based on that and notifies us. So actually we have no involvement at all, apart from the key bit, bringing the pension into payment, as to whether it's based on ill health grounds or normal. That's all with the practitioner and the employer.
So, but let's assume you've left the employ, but you haven't taken your pension for some reason, you deferred your pension.
Yes.
And then how would you apply for that same enhanced pension? Would there be a way of doing it?
It goes back to the employer.
Goes back to the employer? Okay.
Yes, and if the employer has left the scheme, the employer's ceased, then it comes back to me as the admin authority.
Right, thank you. I just wanted to
But
get
also,
an overall view of that.
Ill health can lead to early benefits, but there's no enhancement. So if you're already retired and you suddenly have ill health, you don't get a greater pension.
Right.
But if you die within the first 10 years of receiving your pension, then your estate will get the remaining of that 10-year period. Right. So there is effectively your estate is guaranteed 10 years of pension receipt.
Which doesn't, it's a good thing to have, but it's not standard with pensions, is it? So it's a bonus of having a local government pension. Really.
Yes, it's one of the areas where the local government pension is typically better than but it's also one of the differences of having a defined benefit pension as opposed to a defined contribution pension. Because with a defined contribution pension, there is a pot of money in the individual's name, which would then go to the estate.
Yeah. Okay, sorry, I'm just, that's cleared that up. Thank you.
Okay, any other questions?
Thank you. Rachel, is there, does this any improved in employee productivity and performance target, for instance, reducing late or inaccurate submission?
So that's the area that we're going to target next. We've been looking more at getting the information in first, because there were a lot of information. There was several hundred where we were still waiting for information from individual employers. So stage one has been getting that information up to date, and then stage two will be looking into how long individual employers are taking, and if there's certain employers that are taking too long to get the information in, then we will be speaking with them about why that is and how we can get that improved.
If I may, Mr. Chairman, does it look at improving accountability as well?
Well, yes, it will be, because what we notify all employers is of their responsibilities as an employer in the local government pension fund. So there's guidance, and we are always updating them on what their responsibilities are. And yes, obviously they are individually accountable for getting that information into us regarding scheme members, and there are within the pension admin strategies various options for financially imposing financial charges on them if data isn't received within a certain time period, and that's what we've been starting to look at, as I say. Does that answer your question? Hopefully.
Yeah, thank you, Rachel, because I mean, in the private sector, this is exactly what happens.
Yes, yes. I mean, I'm very pleased that we got to the stage where we got approval to include the charges within the admin strategy, because to date, for the majority of employers, just knowing that that is a priority and the consequences of not doing that has really helped.
Okay, excellent. Right, that report is to be noted. So I don't see any other questions for Rachel. So Rachel, I'd like to thank you again for your reports today. And I think splitting it was a good thing. It allowed us to ask the questions I felt in a much more appropriate way. So I'm very pleased with that.
Thank you.
I look forward to seeing you at our next meeting.
Okay, thank you.
Many thanks
Bye.
indeed, Rachel. We're going to move on to item 9 now, which is the business plan update, and this is to consider the report from our Treasury and Pensions managers. So, Anton, we're going to.
So I'm going to first talk about the items in section 4 and then talk about the work plan going forward. So with respect to the 2024-25 external audit, it's still progressing well. I am in excessive contact with the auditors from my point of view, but very regular. They are still planning to provide their audit findings report to the audit committee on the 29th of September. I have been led to believe I will see a first draft of that report by close of business today. There are still some elements of testing outstanding, but we're hoping that even if they are not completed in time for them to be confirmed within that report, they are, I'm hoping, will be complete by the end of September, not least because it's nice to get the audit out the way, know it's finished, and therefore be able to get the team to sort of get back on track with other work, because the production of the accounts and audit is a significant amount of work. I mean, it's becoming more significant every year. The amount of testing the auditors does increases every year. We're also getting increased level of questions from the auditors of employers as well, which is something we just have to sort of soak up and get on with. But I'm not aware of any significant findings at this stage. Work on the 25 actuarial valuation is also ongoing. I believe it's on track. I need to go back to the auditor, the actuary, because they've suggested a meeting date for me in October and I can't actually make that date. But I'm expecting to have the whole fund draft figures at that meeting in October. And as it says there, it's my every intention that the actuary will attend committee at your December meeting and present the draft report of the actuarial valuation outturn. It will always be draft because Barnett Waddington typically produce the legal final documents in the last weeks of March. Also then to note that there is significant enhanced guidance on the funding strategy statement. This is a document that is Barnett Waddingham as the actuary is heavily involved in producing with me. And it's anticipated that we will have a first draft of a new funding strategy statement that will come to you for the December committee meeting. That will then allow for you, with your permission, for us to formally consult the employers, which we are required to do, and the new guidance requires a greater level of engagement with employers. And we'll also consult with the board, and depending on the outcome of that consultation, our initial thoughts would be that a final draft would come to the March committee for your formal adoption. Is there any comments on any of that before I raise something else? No, I'm going to sort of, with the chair's permission, rather than do as an area of AOB, I'm going to raise an item here. There has recently been a number of emails that I know have gone to 2 committee members, and may well have gone to more of you, from a Palestine Action Group, suggesting they have legal advice that we legally must divest from all companies engaged with Israel in any context immediately. And I believe it's now also on what I refer to as a click and send website. So with issues of this nature, from time to time, they get put on a website where members of the public can click and put in their postcode, and it automatically gets sent to their councillor. And this particular one also comes with a nice thick wodge of paper if you actually printed it out, but a nice thick wodge of legal opinion as to why we must, in their language, divest immediately. The Scheme Advisory Board sought KC opinion in October and November, and that was provided in November, and that advice is available on the Scheme Advisory Board's website, so it's in the public domain. And also the Scheme Advisory Board is currently engaged with both updating that advice and engaging with government to try and provide clarity to the local government sector, because this is not something that's come into Simon and Michael are the two who've sent it to me, to us in isolation. My understanding is certainly gone to every one of the Brunel funds, who I am in regular contact with, and it's our understanding that it's gone to every LGPS fund in the country.
I believe that to be true.
So there's a couple of things. Firstly, under the LGPS regulations, we are not allowed to boycott a sovereign state unless that boycott is supported by the Foreign and Commonwealth Office. So currently, we cannot boycott Israel. That is not well, if you did, you would be ultra-virus, and I would have to advise strongly against it. In the KC opinion provided on the Scheme Advisory Board, as is currently there, the KC makes a number of points. The first is, and is very important, is for any consideration as to whether our holdings in any companies might or might not be illegal, it is under a crime of aiding a crime. That would require the Israeli state to actually have been formally prosecuted for war crimes. It's my understanding that as we currently sit, that has not taken place. So in a court of law, Israel or individuals attached to Israel have not been convicted, and therefore we cannot aid or abet a crime until a crime has formally been deemed to have taken place. The KC goes on further that even if that bar at some point in the future is breached, the idea that there is sufficient proximity in us owning a company that we presume has acted legally in other respects other than selling to Israel, that a fund manager puts in a fund that we then, as a third party invest in that fund, so we're not holding the shares directly, is not sufficient proximity in his opinion. All of this is legal opinion on both sides, that a conviction would in all probability be reasonable or attainable. So we have Casey opinion saying we are not acting illegally. And my advice to you very much is to do nothing until such time as the Scheme Advisory Board comes back to us with specific guidance to do something. I suppose that just some further points in general then. I haven't checked the Emerging Market Fund, but I suspect our exposure to Israeli listed companies is de minimis. We do have exposure to aerospace and defence companies. It's not a particularly large part of the portfolio, but we do have exposure to it. There is something called the UN Compact on Weapons, which is basically provisions against the manufacture of prohibited weapons such as cluster mines. And there are some provisions around the production of nuclear material other than provision to those nuclear states recognised by the UN. So those things are illegal and will not appear in our portfolio. And if they do appear in our portfolio, Brunel will take all action necessary to expunge them. Obviously, with the aerospace and defence area more generally, it is complicated because companies that may or may not be providing weapons to Israel, which we may or may not take a dim view to, quite possibly are also supplying weapons to Ukraine, where I think we would broadly be in favour of that action. They may also be providing weapons to the UK government. And I also sometimes, when I'm feeling mischievous, point out that although not via reputable manufacturers or third parties, they may actually be the original manufacturer of the weapons that Hamas and Hezbollah are using as well. So to say that we wish to divest from companies that are supplying weapons to Israel, I think is something that is very, very difficult to achieve without consequences that we might not support. It's a very, very complicated area. I also note that on the banned list, there is a myriad of companies which include people like Airbnb and Bookings.com. I assume that's because within the West Bank, you can book accommodation using Airbnb. Yeah, so there is the full range on the list that these proponents will come up from the, yes, clearly they are involved in weapons manufacture and can be demonstrated to be selling to Israel, through to the most tenuous links you can possibly think of. And I will stop there, but happy to take any questions on that area.
Okay. Questions?
Just a quick one, if I may. I won't elaborate on Hezbollah, Hamas, or anything like that. But what are the two main material issues impacting performance, and how do we actually mitigate that against them?
So performance is a interesting one. The Western world, specifically Europe, but generally speaking, is arming up as quickly as it can at the moment. And so, generally speaking, profits in the aerospace and defence sector, or at least sales, which you would expect would lead to profits further down the line, are buoyant, I think it's fair to say. I don't think, although we would always defer to our professional fund managers to make the relevant decisions at that time, I think the general consensus would be that now is an upcycle for defence contractors. And so I do not believe this is in terms of share price and returns to us through that mechanism, I do not believe this is an issue. There is a suggestion of an issue in that we are acting illegally. Through best advice, I do not believe that is the case currently. Caroline's going to make a...
Just say, I think Ukraine has changed an awful lot of people's minds in Western investment about defence companies. Because suddenly we've all realised we're actually threatened.
I think recent actions in Poland might have something to do with that as well. Michael.
Yes, I actually responded to this email, and although I would personally not want to consciously invest in any arms industry that looked like it was doing sort of harm we see in Gaza, but I think it's taken the legality of it away and saying, would we choose not to invest in these companies? Then we might decide that that is something that we would want to do. However, trying to pick them out of the funds individually presents what I would regard as an almost insurmountable, I don't know, an almost insurmountable task, because
Yes.
A fund is made up of a lot of different companies, and to ask Brunel to suddenly started either rejecting a fund completely because one company was in it, or asking that fund to individually divest one item seems, by the time we've done it, I should imagine the war will be over. I'm not sure.
I think that's possibly a very optimistic view of the length of wars in the Middle East. Yes, and as I sort of hinted at earlier, there's two areas that I'll specifically address there. One is that the nature of pooling and working with Brunel and a new pool going forward is when we held all these shares directly in our name, then obviously we had full discretion as to what we held or not. Within the pooling environment, if we wish Brunel to change its policies, then we have to agree that as a group of client funds. So I'm not suggesting that our views on this would be sufficiently different to a number of other LGPS funds broadly in the Southwest, but it's not as simple as saying, right, we don't want it, so it will happen. It's, we don't want it, we need to go through a process of discussing that with the 10 funds, we need to come to a compromise agreement that we're all happy with, and then instruct Brunel thereafter. So there is a process and it's not simple. The other thing is always nuance. Yeah, using the Airbnb example, is that really doing harm to Palestinians in Gaza and the West Bank? I don't know. I don't know if it's Israelis, settlers who are offering up their properties for rent, or Palestinian citizens. Also, what proportion of that is that of Booking.com and Airbnb's work at business, and where do you draw the line? And that's what becomes really complicated. And yeah, not to be flippant about this, a considerable part of what we own pushes someone's buttons. So at one extreme, yeah, we've got the war in Gaza, which is truly tragic. We don't support the actions of Israel, as has been stated by the UK government to some extent. Yeah, climate change, yes, we're fully on board with climate change, possibly not to the extent that Sigurd would like us to, but yeah, we do our best, we feel. Yeah, some people don't like the actions of supermarkets, some don't like the actions of banks. If we removed from our portfolio everything that a single person said they don't like, we really would struggle for investments. You know, I could imagine in the current climate, plenty of people dislike President Trump and would advise that we divest from all American businesses. You know, where do you draw the line?
It's a matter of practicality, I think, rather.
There is a moral line, and then there is a practical process.
I think in principle, I don't know, we haven't had a vote on it, but in principle, I'd quite like not to be investing in these things. If I was a recipient of a Somerset pension, I would rather not have my money. But on the other hand, the practicalities of extracting it from the pension funds seems to be not practical. You know what I mean? So, yes, so we can wait for the judgment and see where we go from there.
Wait for any further guidance.
Okay, thank you.
I don't doubt there will be further guidance at some point. Peter, you wanted to make a comment?
Yes, I just wanted to comment on the proximity issue. Well, let me start off first with crimes not committed by anything other than natural persons, and a company is not a natural person. So it may be a legal entity, but it is not actually capable of being committing a war crime on its own. So you're talking about the person who does commit the war crime, the minister who makes a policy decision, the soldier who actually carries out an act outside of policy. You know, to extend it to the equipment is always going to have double-edged. I mean, you're effectively saying that a company such as Heckler & Koch might be held responsible for murders. Actually, if you look at their market, the largest part of their market is with law enforcement and with armed forces around the world that are principally for peacekeeping purposes. There are many companies which have fully divergent portfolios. And so, for example, taking a local helicopter manufacturer and an out-of-date product, the Sea King, whilst there were many tens of nations buying that, there were several tens of marks of that aircraft with a multitude of nations. When you actually look at the work they did on a day-to-day basis, a lot of it was delivering relief, delivering post, rescuing people, things which are entirely beneficial to society, but would not have existed if you hadn't invested in an arms company. So I think the whole thing, the whole sort of link to arms companies is tenuous in the first place. But even if you accept it, you then look at the situation of the horrible things which are happening in Israel, and would actually disinvesting make any difference? Well, even if it made a difference for the, I think, 2, maybe 3 companies, possibly 4. So Israeli Shipyards is majority government owned. Doesn't really matter what the market thinks. That's going to be doing what the Israeli government wants, but it's not really the big problem here, because it's we're talking about a land-based thing. You've got Elbit Systems, which is publicly listed. That has been the focus of all sorts of commentary. The Aeronautics Group, again, publicly listed, subject to commentary, and Smart Shooter, who are a specialist. I haven't recalled seeing them being the target of anything, but you look at Plasan, private company, Rafael, state-owned, Israeli aerospace industries is publicly owned. You know, these are not going to be affected by any decision of a pension fund in Somerset. So I think the thing is that the proximity applies in both directions. Not only are we unlikely to be held responsible any more than, for example, Microsoft would be held responsible for any decision we took because they supplied the laptops we took it on, or I have no idea who supplied the carpet, you know, but it's holding us off the floor. You know, the distance of liability is there, but also you're talking about a non-existent lever. It's infinitesimally small. It's not even a publicly wavable flag of a lever. So I just think this whole thing is misdirection, and I'm afraid whilst I support people being horrified by what's going on, the mechanism that they have chosen to lobby on in order to gain publicity for that point doesn't stand scrutiny. So just argue about how horrible it is. Don't argue that a council should disinvest in its pension funds. Sorry, rant over.
Thank you, Peter. Michael?
Just, yeah, I take your points on board, but I would just be very careful about imagining that companies that produce stuff meant to be for policing purposes is always benign, because I did investigate an instance in Israel or West Bank or Gaza, I can't remember where exactly, where rubber bullets were used. And they're only tested on an adult torso. So when you fire them at children, they have a slightly more catastrophic result. And there was a child who was killed by a policing, if you like, inverted commas, crowd control rubber bullet. And I think we have to be a bit
seem to
careful.
be straying
Yeah,
way
so
off.
I'm just pointing out that these aren't always totally benign
It's
items. And I think that
we
has to be.
get back to
Yeah.
the inescapable point, which, and I'm going to close this discussion down now because we're not going anywhere with it. And we always come back to the final point, which is an individual makes a choice to do something with the piece of kit they have. Now, that is the point of responsibility. When an individual fires in the scenario you described, Michael, of an individual fired a rubber bullet at a child. That is the point. And that is where the decision of a pension fund in Somerset, frankly, is not going to make an iota of difference, in my view. I appreciate other views are available. I think we've given that enough of an airing. If anybody disagrees, please say so now. Otherwise, we are going to move on. There was a recommendation that we noted the business plan update, and we're now going to move on to item 10, which is the finance and membership statistics update. Anton.
Yes, so usual report. Nothing particularly exciting happening with the membership. The trends that have been in place for a considerable period of time are continuing to perpetuate. Then just moving on to the Q1 projection. Obviously, out the outturn of the first quarter, the level of information that provides to where we might be at year end is smaller than later in the year. Broadly speaking, there aren't many items on there other than, well, no, broadly speaking, we are within the parameters I would expect, and I don't really have any great comments to suggest that anything is outside the norms. Happy to take questions.
Okay, committee, is there any questions here for Anton on the finance and membership statistics update? No. Okay, well, we are asked to note that report, and I'm happy that recommendation is followed. Moving on to item 11, which is a review of the pension fund risk register. And this is, again, a report from Anton, and the recommendation is to note and approve the risks contained in the risk register.
And as is normal, everyone's aware this is a report that comes to every committee. There has not been any changes to the risk register since the last meeting, other than around the risk of regulatory change, which we've already increased to red. And the consequences of pooling and that I will come to in due course, etc. I don't believe there's been any particular change in circumstances of the underlying risks, and so I don't propose to say anything else, but happy to take questions.
Colleagues, questions for Anton on that? I think we've discussed it a number of times in recent past. And I think the situation hasn't changed other than the letter we're going to be writing later, which we've already discussed. Okay, I'm going to note and approve the risks contained on the risk register. We're going to move on to item 12, which is the pension fund annual report 24-25. Again, Anton.
First thing I'm going to do is apologise because actually on the paper I've not moved the dates forward and it says 23-24. And it's agenda item 12, yes.
I apologise for reading script.
No, no, it is 12. There's two items. Yeah, I mean, we write it twice on the same page. But I can confirm that it is very much the 24-25 annual report that you are reviewing. As is normal, as I present this to you, I use the covering report to just highlight some broad themes within the document. I'm not going to go through those individually. The document itself is now a burgeoning 270 plus pages.
Joyful.
Yes. And I don't propose to go through any of it in even the scantest of detail. However, I am more than happy to take questions, but it is suggested that you formally approve the draft as is. I'm aware of one minor change to the accounts that will take place. On the note to the accounts, which states the number of members, Grant Thornton wish us to point out that, strictly speaking, what the data we present there is the number of records. It is possible for a member to have more than one record, and so therefore it's not, strictly speaking, the number of members. That has always been the case, but apparently that needs to be pointed out now, and we need to add some wording. I'm waiting for Grant Thornton to provide me some wording that I can slip in, because I'm not entirely sure what I want to draft for that. There may be some other minor changes to the accounts. If they are anything beyond sort of typos and things like that, I will liaise with the chair for further approval. But otherwise, my request is that you formally adopt the annual report.
From the chair, I would suggest that that's an appropriate action. I'm going to bring Peter Seeb in to start with, Peter.
Yes, Chairman, just a quick clarification. Am I right in thinking that what Grant Thornton is struggling for a word for is memberships, i.e. one person could have been in at several points and therefore have different entitlements from different periods?
I'm not sure whether they are struggling to draft the thing or just struggling to pass it across to me. It's more, they said they want a note, and I've said, well, tell me what you want me to write then, because that's a lot simpler than me drafting something they then deem inappropriate. It's just a quicker way from A to B. Ultimately, it's my responsibility on your behalf to draft the accounts and to choose the content. But I don't want to fight with the auditors unnecessarily, although sometimes I pick one in private, but in public, I do not wish to aggravate the auditors for the sake of it. And if they wish me to change it, if in that context, it's not a big deal, I will add it. But I want wording that they are going to then be happy with, and the easiest way to guarantee that is for them to draft something for me to then agree, rather than the other way around.
I think that if the committee is concerned, then I would ask that whether the committee would be happy for any minor adjustments to be agreed between myself as chair and Anton, if there should be any variation required. Rather as I do in planning, Peter.
This is an interesting point. Also, I should point out. So, we are required to publish this document by the 1st of December. In some senses, you could argue I've already achieved that because it's published as part of your papers. So the formal adoption is in that context. I should also point out that the other thing that isn't currently in the annual report that will appear there is the auditor's opinion as and when it is provided to me. But we still live in this quasi world, which one day someone might sort out, in that because the pension fund is not legally a separate entity from the council, the pensions accounts, one, go to the audit committee rather than come here, which I've always found slightly bizarre, but also that external auditor GT will not provide an opinion on the pension fund accounts, despite the fact that we hope they will be closed by the end of this month and completed and their opinion effectively written. But they will not provide that until such time as they do the same for Somerset Council's accounts. And so the final document with their opinion in may not appear until after Christmas, let alone the 1st of December. And that has been the case for the last 2-3 years, that we've missed the 1st of December deadline with no particular consequences that I'm aware of.
I think that's an excellent summation of where we have been for the last couple of years and where we are likely to be for the next couple of years until changes are made.
There once in a while, there is a suggestion that government will formally stipulate that the pension fund accounts should be separated from and not form, because our accounts, as well as being in the pension fund annual report, form an appendix to the council's accounts. There is a suggestion that at some point in the future, and we are nearer now that it happening in the next year than perhaps we've ever been, that they will formally split that out, and that then we probably will go to a position of the pension fund accounts coming to this committee and GT reporting to this committee and the sign off being completely separate. And I think that would be beneficial to all concerned.
The only comment I'll make is, Anton, you again persist in using common sense. And sometimes
I sometimes
it's not
don't,
that
but I try to keep that in private.
Okay, so we're at a position where the recommendation is that we approve the annual report, subject to the addition of the external auditor's opinions. We've discussed the timescale for that. In the end, the external auditor requiring changes to the accounts prior to the provision of their opinions, it's requested that the chair is given the ability to approve those amendments on behalf of the committee. Obviously, that will be in conjunction with discussions with Anton. So.
And I think there is a level at which, if the auditors came back, and I'm not expecting anything unusual, that was the conversation I had with them yesterday, but if they came back and said, actually, no, your accounts are completely wrong and need to be rewritten from scratch, I would not expect the chair to want to take that on without further conversations with you all. So there is a sort of a level.
I can assure you it wouldn't. There we are. Okay, can I see those in favour of that, please? Thank you. It's unanimous, I'm happy to say. Okay, well, we're now coming to the point where we are going to have the update on pooling, and I'm going to say that I in conjunction with my conversations with Anton, we are going to exclude the press and the public from this. We are going to go into private session, but we are going to have a 5-minute comfort break first. So it's just coming up, yeah, a couple of minutes of midday. So we'll call it a 7-minute break and come back at 5 past. Okay, Peter. I will do when we come back. We're having a 5-minute comfort break, but when we come back, I'll pass the resolution.